Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for today's battery and precious metals presentations. Our next live presentation comes from Giga Metals Corporation. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you're interested in scheduling a meeting with Giga Metals, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Mark Jarvis, CEO and Chairman of Giga Metals Corporation, which trades on the OTCQX Best Market under the symbol HNCKF and on the TSXV under the symbol Giga. Welcome, Mark.
Well, thank you very much, and I'm very happy to be here, and I just want to welcome everybody that's listening in. So this first slide shows where our camp is, and we've also got a 1 kilometer airstrip right beside the Turnagain River, so we can land fixed-wing aircraft here. There is a road to the main highway, but it's a road that's going to need quite a bit of upgrading to support a mine. But as you can see from the terrain, this is quite easy road building terrain. You need a road, no mine. And this is a standard disclaimer. So within the last year, we did a transformative transaction with Mitsubishi Corporation. Now, many of you probably have heard the name Mitsubishi, but you don't necessarily know all about them. So the part that matters, I mean, it's a huge Japanese company with many, many different parts. The part that's of interest to us is their battery metals division, which is part of their raw materials division, which is part of their trading arm. They are the largest commodities trader in Japan. They're very sophisticated about mining. They have a model where they like to own a minority interest in the mine. They prefer others to operate, and they help you get the mine built. They come in with financing. They've got two banks within the group. One of them specializes in mine financing, and they're wonderful partners. They're mostly interested in offtake of the raw materials. And in our current deal with Mitsubishi, they've got 15% of the project, so they've got 15% of the offtake. And we are fully funded to complete our pre-feasibility study, which we're currently expecting in June. And this is a much more detailed engineering than we've done previously. Another thing about Mitsubishi, and one of the things that attracted them to our project, is they're very interested in being good environmental stewards. And we have a project that is, a giant nickel project that has a real shot. It's certainly going to be among the lowest carbon intensity nickel projects in the world. It may even be carbon neutral. It may even be better than carbon neutral. And we'll get into how that can work in later slides. So we're TSXV listed. Our engineering report, our preliminary economic assessment, modeled an average of 33,000 tons a year of nickel. And we model building it in stages. So that average includes the first 5 years where we're operating at half speed. At its peak years, we produce up to 44,000 tons per year of nickel in concentrate. It's a 37-year mine life, and the concentrate is 18% nickel and 1% cobalt. So there's a significant cobalt kicker to this. We're in a good mining jurisdiction, British Columbia. We've got a long history of mining in British Columbia, and particularly large open pit mines are something that we do quite well here. So we've got our main infrastructure challenge is getting the BC Hydro power line to our site. And there's actually a very good possibility that we should get some help. There's government infrastructure funds to support development of critical materials. And this seems to me like a very good project for that use. And we are having conversations on all levels of government, federal, provincial, and First Nations, to try and see if we can get that BC Hydro line extended to the north. Our updated mineral resource statement, I said earlier, this is a giant deposit. Well, here's why I say that. In the measured and indicated category, we've got 7 billion pounds of nickel, and we've got 433 million pounds of cobalt. And then in the inferred category, another 5 billion pounds of nickel. So this is really, really a large deposit. And this is a very recent update to our mineral resource statement. And this is the resource statement we will be using in our pre-feasibility study. And this is a plan view of the ultramafic intrusive. And you can see that this giant resource is contained down at the bottom where the concentration of drill holes are. But this deposit is open to expansion. We think we've drilled somewhere between 20 and 25% of what's prospective within the ultramafic intrusive. So we have got tons of expansion potential. As the saying goes, this deposit is open. And again, once you get it up and running, it's a significant capex. The PEA modeled US 1.4 billion for phase 1, and then another $500 million for phase 2 to double production, essentially. So all of the infrastructure costs get taken care of in phase 1. But we are quite competitive economically. We can make nickel in concentrate for a total operating cost of $2.81 a pound in concentrate at the mine gate. And here's our projected yearly production over the mine life. So this is a project. The reason it's not built yet is the economics are marginal at the low end of nickel prices. And so I understand there's maybe 20 projects worldwide of a similar size. We're at the large end of those, but that also includes the giant laterite projects. The ones that are undeveloped because we're all kind of in the same boat. At very low nickel prices, you're not going to get this project built. But at current nickel prices, and I think we're around $12 a pound right now, this project does get built. We are within the range where the economics are quite robust. And we expect prices to remain high and perhaps even get higher over the next couple of decades because of the rise of electric vehicles. That's the entire story for nickel right now. There's a quick comparison to the other large low-grade open pitable deposits in Canada. I just want to note that we are the only one that has engineering modeling production of Class 1 nickel. The other projects have all done engineering as ferronickel projects. In other words, they're addressing the supply chain for stainless steel, not for batteries. And here's our timeline. Hopefully we could start production in 2027 or 2028 if everything goes well. And our concentrate is a very desirable product for smelters, and that's what we are modeling selling to, is smelters. But this is also a product that if you put it through a simple pressure oxidation circuit, a relatively simple circuit, that you can make anything. You can take this and using pressure oxidation, you can make MHP, you can make sulfate, you can also take it on and make make briquettes or even metal, depending what you add onto the circuit. So there's a lot of flexible downstream methods to treat our concentrate. This is a picture of the valley where our tailings management facility will go. We have designed, it's called Flat Creek. We have designed the safest tailings management facility it is possible to design. Central line construction, everything to make it really safe as we've done. It costs more, but I think that that's necessary, and that's entirely our philosophy. And we're in an area, by the way, of very low seismic risks and relatively low precipitation. And here's a plan view of our tailings management facility. So as you can see, we've got a limited scale pond, and we've got a lot of beach, as they call it. And the reason we've designed it this way, two reasons. One is this is quite a safe design, but also our tailings will absorb CO2 from the atmosphere. And these silicate tailings, predominantly silicate tailings, absorb CO2 and convert to carbonate minerals. And so the CO2 is locked away for geological time periods when you do this. And also, as this happens, the sands go through a partial cementation process, thereby increasing the safety of the tailings management facility. So, and this CO2 uptake by the tailings can be measured. And we're working with a professor at the University of British Columbia, Dr. Greg Dipple, who's been studying this phenomenon for 20 years, and he's developed methodologies to measure the CO2 uptake, and it is significant. This is just a price chart of nickel historically over the last 40 years. The black line is in current dollars, or in 2022 dollars. And so, as you can see, every so often nickel goes crazy, and things are upticking right now. I think they're upticking because of the electric vehicle revolution more than anything else. The Class 1 market, which is the easiest form to convert to, or one of the easiest forms to convert to batteries. Another, there's a number of chemical forms as well that are not technically Class 1, that are, sulfates, for example, are a chemical form that are easy to convert to cathode materials, as is MHP. But anyways, the Class 1 market is getting tight. And that's part of the reason why prices have been picking up recently. Batteries have gone from 2 or 3% of the market to today's 14% of the market just in the last few years. And that is the most rapidly growing section of the market. And to feed the projected demand for electric vehicle batteries alone, you need, over the next few years, 1.5 to 2.5 million tons a year of incremental supply of nickel. And this is in a market that's roughly 3 million tons a year right now. So it's a very significant increase. You need 40 to 70 large new mines. And by large, I mean on the same scale as Turnagain. So I think all the mines that are out there that are known, nickel prices have to go to a price where we are incentivized to build these mines, known as the incentive price. And, And if prices don't move there, then the mines don't get built, and you don't have the nickel, you can't have the EVs. So it's all, I look at commodities pricing in very simple demand and supply terms. You can get very fancy about projecting commodity supply prices or commodity prices, but I think demand and supply at the end of the day always wins. And speaking of demand, here's a list of battery projects, gigafactories that have been announced in North America alone. And in North America alone, you need 250 to 450,000 tons a year of new nickel supply, above what's already produced, just for these factories. And the difference is 250,000 tons a year would assume that more than half these factories will be producing LFP batteries, which don't use nickel. It's lithium iron phosphate. They are much less energy dense. It's a good technology. They're good for some uses, but you don't get anywhere near the kind of range you get with nickel-based chemistries. So depending on the proportion of LFP to nickel-based chemistries, that's the range. It's enormous. And when you think that our project is a large project and it's about 33,000 tons a year on average, you need quite a few of our projects our size, to get there. And frankly, I don't know where all those projects are. This is just to show that the mix in batteries, I'm not going to dwell on this. You can go to our website, by the way, and you can review this stuff in detail. LFPs are going to be part of the market, but nickel-rich chemistries are going to be a very large and growing part of the market as well. And here's where we are for nickel production right now. Not that much. Total refined production in North America was 124,000 tons. So we need to more than triple the amount of nickel we're refining in North America just to feed these new battery gigafactories that are being planned. And these are the undeveloped projects. The ones in green, like ours, are the ones that are modeled and have engineering done on producing Class 1 nickel. The ones in blue are modeled on producing ferronickel for the stainless steel business. Now, Canada is a free trade partner with the United States, so raw materials from Canada qualify for the Inflation Reduction Act. This is, very good for projects located in Canada. And the total refined nickel production from free trade allies, is 222,000 tons per year. So again, even if you bring in Australia, there just isn't enough nickel from free trade allies to supply the growing electric vehicle business in the US and to qualify for the Inflation Reduction Act. Now, the other major type of nickel deposit, there's two. There's sulfide deposits like ours, and then there's laterite deposits. And laterites are basically, if you take our deposit, expose it at surface, and rain on it for a couple of 100 million years, the rock breaks down and becomes clay. And the deposit gets a lot smaller. The grade of nickel goes up because you're dealing with a smaller volume, but you've got nickel essentially in dirt and clay. And so it's very difficult to extract the nickel. It's very expensive. And you use something called high pressure, high temperature acid leach. It's a very complicated technology. It's failed technically many times. And even when it works, and they are getting better at it, when it works, it's expensive. And so this is a comparison of our cumulative cash flow at the base case of $750 a pound nickel, which is what we use in our PEA. The This is a comparison of Turnagain versus an HPAL project, a successful HPAL project. So we have better economics than successful HPAL projects. The other comparison is, we will be an open pit mine. And this is a very, very large open pit, but it goes deep, and the surface disturbance is relatively small compared to the amount of rock that's moved. Laterite deposits are typically thin, and they're strip mines. So they go on and on for mile after mile. And in Indonesia and Papua New Guinea and other places where there is a lot of laterite, they just mow down the tropical rainforests. It's just amazing what they do there. They process it with HPAL, and in many cases they dump the tailings into the ocean. And they're extremely carbon intensive. A lot of the processing is done, and they're very energy intensive. It's done with coal-fired power plants. So if you're getting your battery materials from HPAL projects in what's called the Coral Triangle, well, it's not environmentally, it ain't pretty. So sulfide deposits naturally have a low carbon intensity, and especially if you get into making nickel pig iron, as they call it, and then converting it to matte, the carbon intensity is off the scale. And so this is where we sit right now in terms of emission intensity of probable nickel projects, already quite low. But if we use electrified, mining fleet, which is being developed, it doesn't really exist yet, and so it's not included in our engineering at this point. But if we use that, and we will use it when it's available, that brings the carbon intensity down even lower. And if we factor in what we already know about carbon sequestration in our tailings, we can get to carbon neutral to produce concentrate. Here's our board. I'd like to point out a couple of members of the board. Martin Vidra, who is also our president, and Bob Morris is a director. Both of these gentlemen have a ton of experience marketing nickel and cobalt products to end users. And, Martin had a career at Sherritt, and Martin has taken the lead on our internal process, looking for strategic investors in our project. And I give him full credit for bringing Mitsubishi on board. Just working on relationships that he had already established, and he just understands how the end users work. Bob Morris, before he joined our board, about a week before he joined our board, he resigned as a senior executive vice president. He was in charge of worldwide sales of base metals at Vale, which is the giant Brazilian mining company. And so he was in charge of copper, nickel, cobalt, also precious metals. It was a portfolio during his tenure that ranged between $5 and $8 billion a year, depending on commodity pricing. And so he also is very helpful in terms of dealing with potential strategic investors. And our hunt for strategic investors goes on. We've started with Mitsubishi. They now own 15% of the project. We're looking for another investor to come in for, say, 20% of the project. And we have been talking actively to car companies and battery companies, amongst others. And there is real interest. That is an ongoing project. Stay tuned with regards to that. And I'll leave it here. Here's our capital structure, and I'll open it up to questions. So I got a question, what is the projected mine life for Turnagain? Well, it's currently 37 years, was in the PEA. In the pre-feasibility, we will only use measured plus indicated resources. And I don't know the mine life yet. The engineers have to do their work, but my guess is it'll be similar to the PEA. maybe a bit higher, maybe a bit lower. I've got a question: are the margins for steel worse than sales to battery makers? I'm not sure. The other projects in Canada, the other large low-grade open pitable projects that all model selling to the stainless market, model it that way. They say, well, we'll sell it to a roaster, and they will roast our concentrate and oxidize it, and then sell it on to the stainless business. And their models say that the payables for nickel will be 91, 92, even 98%. So I'm not sure if that's true or not. I don't think anyone's ever done it before, so it's a bit speculative. We model selling to a smelter, and we model payables in the PEA of 78%. So, but that's a market that exists, and we know what the terms are in that market, so we're not guessing. But it's also, we think the future growth in nickel is in the battery business. So long term, you're going to want to be in the class 1 business. You're going to want to be in the battery supply chain. We think that ferronickel for the stainless business is very well supplied in the world, and we think it's more challenging to bring on sources of nickel that work for the battery supply chain. Are there any Canadian or U.S. government programs to support development of domestic nickel supply chain? Yes, there are. And what I mentioned before, one of them is there's a $1.5 billion Canadian fund to invest in infrastructure to support development of critical minerals. And we're proposing that roughly 150 million of that be spent to extend the hydro line up to Dease Lake. And we're getting a good hearing. Nothing's done till it's done, but we think we've got a real chance of getting that. And if we did, that would take 150 million US dollars off of our CapEx and would improve our economics substantially. I'm looking for more questions. I'm not seeing any. So if there's no more questions, I think I'll thank you all for showing up and bid you adieu.